Okay, great. So we have more people joining us, so we will start today's webinar. So yeah, thank you for everyone who's joining us today. Today's webinar is the insightful views about the macroeconomic environment, inflation, central bank monetary policy, financial markets, and investment strategies to protect wealth in uncertain economic times. And given what's happening at the moment, I think uncertain economic times sums it quite nicely at the moment. So we're going to go through the webinar. It's going to be quite detailed. There should be some content for everyone in there. I mentioned again, we've got our post-webinar Q&A session. So we're going to take the conversation across to YouTube, Facebook, which is where we host our weekly live podcast, the Money and Finance for Expats podcast. So there's a link in there. I will try and put the link in the chat as well. Just simply go to our YouTube channel, Fiduciary Wealth Management, and click on the live videos. You can join us then. You are more than welcome to ask anything that you want. We're there to answer the questions, or at least Paul is. And talking to Paul, we'll get going now. So Paul, if you can start and just maybe give us an overview of the current macroeconomic environment.
Good morning, Matt. Yes, I'd be delighted to do so. At our last investment webinar, which was in September 2022, my answer to that very same question about the macroeconomic environment was that, it was deteriorating very quickly and we were heading towards a recession. Things have changed since then, and I want to explain how, but always with a caveat, and let me caveat that statement at the very end. So we will fast forward 6 months, and certainly since the start of 2023, we're quite surprised to see that the tighter financial conditions, meaning higher interest rates, have had a negligible impact on the global economy, and far less than we would have expected. In fact, if we look at the leading indicators, which are forward-looking and predictive of where the economy is heading, aside from an inverted yield curve, the economy appears to be on a solid footing. Now, before I start looking at those leading indicators, whether they're US, principally US, but I think the same applies to the UK and the EU, since the data patterns show a similar path. But let me caveat the statement. Our view since the COVID hasn't changed. I think the global economy remains in a precarious position for the simple reason that it's carrying too much debt, and the genie, meaning inflation, is out of the bottle. So whilst the data is proving to be resilient, and I can explain why and in detail over the course of this presentation, I need to say that anything can trigger a deep recession. Financial markets are very tightly priced, and all it requires is a fast deterioration in financial economic conditions for the situation to change very, very quickly on the ground. So whilst our message is fairly positive, it comes with a big warning that the underlying economic trends remain weak and susceptible due to the uncertain economic times that we live in. So looking at the leading indicators, let me first look at the yield curve. The US yield curve remains inverted. So normally, and you can see the graph there, and the green line, normally a yield curve is upward sloping. So the longer you go, and if you look at the bottom axis, which the horizontal axis tells you the time period, the yield over 1, 2, 3, 10 years, 15 years, 20 years out, 30 years out. And the vertical line axis tells you the yield, the return, on US treasuries. Now, normally yield curves are upward sloping. The longer you go out in time, the higher the yield because the greater the risk. But this is an inverted yield curve. And inverted yield curves in the past have been one of the best indicators of a looming recession. In fact, it has successfully predicted the last 7 recessions in the US. However, the yield curve is not a perfect predictive tool or model. For example, in 1966, we had an inverted yield curve in the US, yet the United States managed to avert a recession. So, whilst it is a good tool, it doesn't give you complete assurance that you can't rely on it completely and say, we've got an inverted yield curve, a recession is coming. But it's a good predictive tool. Now, if you adjust the yield curve for inflation, then the yield curve might look slightly different. And we haven't gone into that depth because I think that is taking it too far. Maybe in a subsequent investment webinar, we can explain the difference between an inverted yield curve and one which is inflation adjusted. So the yield curve is definitely pointing to a recession. But let's look at other leading indicators to see what they say. So the second one we're going to look at is the durable goods orders. Now, durable goods tells us what companies and consumers order. So we're talking about big ticket items such as furniture, cars, and long-lasting appliances such as washing machines. Now, January's data came in very strongly at plus 5.6%, which is the spike here. I don't know if you can see where I'm marking here or not. Is that seen just here at the top? Anyway,
we can't, Paul, but
okay.
we can see just towards the right hand side of the graph.
Yeah, there was a spike in January. However, February's data, we can see a decline by 5.10. So, and that's the sharpest fall we've had since April 2020, which was the onset of the COVID pandemic. So what the data suggests is that the goods sector in the US is experiencing some price deflation impacted by higher interest rates. Now there's nothing unusual about that. If you think about it, Matt, when consumer, the cost of living crisis is squeezing consumer spend, then you have to cut down on your expenditure, and the first things that go are the luxuries, right? And if you can postpone replacing your washing machine, you do. If you can avoid, furniture, you do. It's not a necessity, right? So I think it's consistent with a squeeze on consumer spending as well. But the one thing you have to consider also, and I think our viewers need to consider, is that historically, and you can see the graph going back to 2007, durable goods orders tend to swing quite widely. And the reason for that is a large proportion of the data relates to commercial aircraft orders, right? And we're talking about large orders, 10 new Boeings that can have, that can really swing the figures one way or another. So I don't think there's a big decline as we had. If you look at the 2020, that sharp decline in 2020, which was indicative of the recession. I think this is more the normal swings that you have during the course of any cycle. So that's durable goods since the global financial crisis. Let's look at housing starts, if we may, Matt.
Okay.
So those are housing starts. Now, US housing starts, those are new builds, new houses that are being built at a current level of 1.3 million, which there's a line there to depict, like a bottom, 1.3. The month prior, the figures was 1.37. And you can see that in 2022, when the US was building housing at a monthly rate of 1.8 million, there's been quite a steep and heavy decline. So shrinking demand for new housing suggests that the economy is indeed slowing down. And real estate, as we all know, is a significant component of the US economy. And I mean, this suggests, again, that financial conditions are indeed tightening, so it will not just slow down the economy, but it will bring down inflation. So durable goods, the fact that durable goods are slightly down, and the fact that housing bills are coming down will have a disinflationary effect on the US inflation data. So to be expected when there's a tightening of interest rates, but there's a positive element to that, in that it'll bring down inflation. So that's housing starts. If we look at the ISM, the Manufacturing New Orders Index. So this is a survey of more than 400 purchasing executives in the manufacturing sector, and it's indicator of the overall health of the US economy. Of the manufacturing sector specifically, and the general economy, and the US economy more generally. A reading below 50 suggests that the manufacturing sector is indeed contracting, again indicative of a recession. The January data came in really low. Again, it's just the figure here at 40.2. However, the February data has seen a sharp rebound to 47, which is still below the critical 50 threshold, indicating we're in recessionary territory, but it has bounced back. So rather than see a continuing decline as we saw during the global financial crisis, where the manufacturing new orders came, the index data came in at as low as 25, it seems to be holding on in contractionary mode, but still not clearly in recession. So that's durable goods. And then I want to bring in another another leading indicator, which is the Conference Board of Leading Economic Indicators, because that is a more general publication, and the US Conference Board publishes a leading index, which is a very, very good indicator of where the economy is heading. So, Matt, there should be a graph there. Is there a graph? Exactly. So there we are. So the US Conference Board publishes a leading index. I mean, it is followed very, very closely by the market because it measures 10 key economic indicators. Admittedly, they're not all leading indicators, but a good number are forward-looking. So it's the best predictive model that one can use. And the data has decreased in February for the second consecutive month, and the index is down at 102.90 from 106 in January. Clearly, there's early signs that the consumer is pulling back on their spending in the face of higher prices and rising interest rates. But there's no evidence of an economic slump as such. I mean, as you can see, during 2020, there was a sharp decline in the matter of 1 month during the onset of the COVID pandemic. But now it's clearly there's a slowdown. That assumption is not being questioned, but the economy seems to be holding pretty well. And the reason for that is that the US jobs market and wage growth is proving very sticky and keeping the economy going. So long as the job market remains resilient and wage growth continues to grow, then I think the leading indicators should hold well. which is exactly what they're doing now. Clearly, if the jobs market does capitulate, weighed down by ever higher interest rates, then yes, potentially a recession may follow, and it could happen very, very quickly. So ultimately, it hinges on how far the Federal Reserve goes in terms of increasing its interest rates and how long they keep interest rates high for. But the leading indicators show, perhaps a slowing down without a doubt, but it doesn't show that the economy, the US economy, has capitulated, that the recession is around the corner. Again, I'd like to caveat that, Matt, because the global economy is sitting on a lot of debt. That debt is unsustainable. The debt continues to grow, with most countries reporting budget deficits. Interest rates are at all-time high, and the central banks have very, very few tools to control inflation other than increasing interest rates. And interest rates cannot be increased significantly, because then the debt servicing cost for a lot of the advanced and developing economies will increase significantly. So they are between a rock and a hard place. And if they make a policy error of any sort, then this can change very, very quickly. And a liquidity crunch, and the markets just crash, and we go into a deep recession. So we are almost, it's a very thin wire.
Perfect. Thank you, Paul. It was a brilliant start. And we move on for more. So look, there's an inflationary problem at the moment. How are the supply chain disruptions contributing to this?
Good question, Matt. Nothing has really changed since we had our last investment webinar in September. The war in Ukraine continues to rage on, causing supply chain disruptions, particularly in terms of food and gas, which feeds into the inflationary narrative, because there's a supply-demand imbalance. Although, admittedly, in Europe and Germany in particular, they've looked at other sources of gas and oil. So most countries are, at least in Europe, should have done a long time ago, ending that dependency on Russia. But so long as the war rages on, and Putin stays in power, we're going to have those supply chain disruptions, at least in terms of the agri sector. Ukraine is the breadbasket of Europe. There's a lot of grain being produced. That is clearly feeding the inflation narrative. As I said, the energy sector also affected by those supply side issues, keeping energy prices supported. We know, Matt, that renewable forms of energy cannot be produced and stored in sufficient quantities to replace oil and gas, at least not now. And the transition to the net zero emissions is light years away. And in the meantime, I think we will continue to be dependent on oil and gas. So really, in essence, and in answer to your question, I think nothing has changed. I mean, the oil majors are not really investing in production. They're not drilling new oil wells, preferring to preserve their cash due to the push towards clean energy sources. So the fact that they are not expanding production, even during a crisis, means that oil prices will continue to be well supported. I mean, what governments should really be doing is incentivizing the oil majors to ramp up their production during this period of economic uncertainty. That would be really a more effective policy to bring oil prices down, but they're not doing that.
Okay, perfect. And Paul, you mentioned about the global debt levels. I mean, I was going to ask, are the global debt levels sustainable? But you've almost kind of answered that earlier. So in that sense, what economic levers do governments have to kind of get out of this mess? Because clearly there is a big mess when it comes to the global debt.
Well, I mean, the one clear way that they can do it is what they're doing now. On the one hand, they are making noises and pretending that that they care about inflation, but actually the best way of deflating the debt is to run a very high inflation, much higher than the rate of interest, the cost of servicing your debt. So, the US has a debt burden of $31.5 trillion. If you run interest rates at 5 and inflation is running at 10, then in real terms, your debt is losing value by the difference, by 5% every year. So that's the only path to turn things around. It's a very tricky very tricky period that we are entering because, as I said, high debt, high inflation, wars raging, economic uncertainty. It is really a tricky, and nothing has really changed since we last spoke. Budget deficits and growing debt levels remain order of the day. NATO, the European Union, the liberal democracies are currently funding the defense requirements of Ukraine to try and expel Russia from its territory. And this will only exacerbate the debt problem. And there's no no change in sight. This graph is really interesting, Matt, because as you know, all NATO countries, when they join the NATO alliance, they pledge that they have to spend 2% of their GDP in the contributions towards NATO. Yeah, that is their requirement. And even though all the NATO countries mocked Donald Trump, and believe me, I'm no great fan of Trump, but everyone was mocking him. All he was saying, in fairness to the man, was that if you join a club, and one of the qualifying conditions is that you need to make a contribution based on the size of your economy, then you have to keep your promises. And in fact, with the exception of the UK, the US, and I think one or two Baltic states, maybe Poland was another one, most of them were paying well below their commitments and requirements for being a member of NATO. So what we're seeing now is, and they haven't done it willingly, Matt. They're doing it because of the war in Ukraine, and they're having to help Ukraine because, remember, Ukraine is the front line, and then there's Europe. Yeah. So Ukraine is providing a buffer zone to protect the rest of the NATO countries in Europe. Then it's in their interest to continue to arm Ukraine, but it comes at a cost. Now, at a time when they're running budget deficits and their debt levels are very high, they have to ramp up again. Another factor that feeds into debt levels and more problems. They're having to increase their expenditure by, most countries by almost 1% to meet their commitments. Plus all the other funding they're giving, and the, tanks and MiG fighters and whatever else they're giving to Ukraine. So a really big problem because it just feeds into the narrative. More debt, more inflation.
Of course.
And more spending because, wars are not cheap.
No, wars are not cheap, and obviously there's politics involved in this, and as you say, the kind of protection of the Eurozone. So yeah, it contributes to it. So I think one thing we didn't mention is the timing of today's webinar. The Fed are meeting at the moment, and they'll obviously be talking about, will they be increasing interest rates anymore? And there's a lot of debate about that. So let's add our thoughts to that. So central banks, are they in a position to increase interest rates now in this contracting global economy?
Well, that's a very good question. You're right. The Federal Reserve is meeting yesterday and today as we speak. I think the market was initially pricing in 2 weeks ago a rate increase of 50 basis points, 0.5%. But events last week with the collapse of two US banks, which we will cover shortly, has changed sentiment in the marketplace. Whereas before there was an 80% chance of a 50 basis point increase by the Fed. Now, probably the odds are that we're going to see a 0.25% increase in rates, and even 20% of market participants are predicting that perhaps the Fed will be forced to pause interest rates. I don't think so, but it could happen. If it does, it would be very positive for precious metals, particularly gold. But I think 25 basis points, a 0.25% increase is probably very likely. But wow, huge risks the Federal Reserve are taking, and I'll cover that when we talk about the US bank failures. But onto your point, Matt, and apologies for digressing, because it's such an interesting and fascinating subject, and it conditions what's going to happen in the market. So yeah, interesting to see where we go from there and what the terminal rate will be. As I said 2 weeks ago, it was something like 5.25. Sorry, about a month ago, 2 months ago, they said, 5.25. Perhaps 2 weeks ago, sentiment had changed and they said the Fed will raise rates to 6. And now, well, let's see what Jerome Powell has to say for himself. After all, he landed us in this deep hole. So yeah, the market, look, Matt, the market is expecting some kind of capitulation in terms of interest rates at some point in the second half of 2023. Whether that materializes or not is anyone's guess. For now, I think, as I said earlier, the economic data shows that, whether you look at UK interest rates, Europe or the US, is pretty much the same picture. I mean, the economic data is holding really well, and unless there's a trigger, and we can talk now about the banks, and there's a rapid deterioration in economic activity, rates will remain restrictive, and there's a risk the market might, or the Federal Reserve might make a policy error and keep rates too high for too long. But the graphs show the US is leading the charge in terms of high interest rates, but the EU and the UK is following suit. The path is more or less the same. Look at them, Matt. In 1 year, they've increased from 0. Look at the straight line till, at least in the EU and the UK is the same, for so long. And then suddenly, bang, come January 2022, it's just the fastest increase in rates ever. But we mustn't forget one thing. Central banks have dual mandates. On the one hand, they have to keep stable prices, so keep inflation at a maximum of 2%. But they also have a responsibility and a duty to maintain full employment. And these are, in the current environment, conflicting objectives. You cannot do one without hindering the other. So while central banks have turned their attention to fighting inflation, at some point the question is whether they have to focus on employment. I mean, clearly the Federal Reserve is crossing the fingers that they can engineer a soft landing with minimal impact on the economy, whilst reducing inflationary pressures to a more manageable level. Whether that's 4 or 5%, who knows? It's certainly not going to be, the old 2%. Because that's going to be extremely difficult in the current macroeconomic environment. But the danger is, Matt, and today is a key, a key date in terms of what the US Federal Reserve is going to do, is will they make a very bad policy error and stick to their guns that they need to increase rates to stem inflation, knowing full well that inflation is much higher than actually reported. And if they do, what implication it has for the banks, yeah, for the sector, for the global economy. There's, look at the inflation. I mean, there's disbelief in many quarters that inflationary pressures are not receding as fast as many would have hoped. But should it surprise anyone? I mean, we are seeing a kind of leveling off of inflation, but not sufficiently, right? It peaked at what? At 8 and a bit, and it's, sorry, at 9, just over 9, and it's over 6. So look, the disinflation in the durable goods sector and the housing sector is pushing down inflation, but not as fast as anyone hopes. But you know, when it comes to inflation, easy money, quantitative easing was the spark. Supply side constraints from post-COVID restart of the global economy was the flame. The global energy crisis is the paper, and the war in Ukraine and ensuing food crisis is the petrol, which is being poured on top. And we haven't even mentioned the increases in defense spending as a result of Russia's expansionist policy. You know, put all that into the melting pot, and it's disastrous. So yeah, the Fed is behind the curve in terms of inflation, and you know what it's shown is first they said, they sold us a story that inflation was transitory, and now they've become incredibly hawkish and restrictive in their monetary policy. But the inflation genie escaped from the bottle a long time ago. Raising rates aggressively is risking precipitating a recession down the line. Historians will no doubt try to make sense of the events, the causes and the effects, and compare this to the oil crisis of the 1970s, because history has tends to repeat itself over time. And if we go back to the history books, we can identify patterns which just happen time and time again. And I think the closest one to the situation we are now, Matt, is the great inflation during the 1970s. There were 3 inflationary waves, and interestingly, each one was worse than the previous one. And the principal causes of inflation then were the Vietnam War, which you can replace with the war in Ukraine. It was the oil crisis shock, and you can replace that with the with supply side constraints in terms of oil production. So yeah, there's a lot of similarities in that regard. But today's inflation is due to money printing, Matt. And that's probably the one thing I would like to highlight, quantitative easing. And whilst financial conditions may have tightened, the financial system remains awash with liquidity, which was injected during the pandemic. And I think that's something that we should focus on. So to put it into perspective, and there's a graph showing, and if you can share that graph with the listeners, there was
Is this the Fed balance sheet?
Yeah, the Fed balance sheet.
Let's bring that one up. There we go.
Because everyone talks about, I mean, even top economists, they say, oh, we're tightening interest rates so aggressively. Why is inflation still raging on? I mean, there's 101 reasons why it's raging on. I think I've covered most of them. But the important point to remember is you can increase interest rates, but the size of the Federal Reserve balance sheet pre-pandemic, which you can see here in 2020, was $4 trillion. 4 trillion. And then during the pandemic, the Federal Reserve were buying US Treasuries and mortgage-backed securities, etc., to try and anchor interest rates at zero. So it was a deliberate policy to keep rates anchored at zero, to try and make sure that the global economy didn't go into a deep shock. And to be able to buy those securities, they had to pump money into the system. They were pumping money, using the money to buy securities, right? To keep interest rates anchored at zero. So the Federal Reserve balance sheet mushroomed, as you can see here, in no time at all, from 4 trillion to 9 trillion. So that's an increase of 5 trillion in a very short space of time. Now, it started reversing that process through quantitative tightening, which is the opposite of quantitative easing, in June 2022. So they started reducing the balance sheet. As you can see, it starts sloping down since June at the very end of the curve to the right, at the rate of 45 billion per month. And then it increased that to 90 billion per month in September 2022. Essentially, what it's doing now, Matt, it's allowing the bonds it holds in its balance sheet to mature. So when they come to maturity, rather than replacing them and issuing another bond in the market to keep that liquidity, this process, which is known as quantitative tightening, involved basically the draining of money from the system. Now, if you think about it, you know, whilst they've been draining at the rate of 90 billion, it's too little. We are in March 2023, and the balance sheet, as you can see here, the Fed balance sheet is 8.3 trillion, 4.3 trillion more than pre-pandemic. And this is, well, firstly, it will take the Federal Reserve at the current rate 3.5 years, or until July 2026, to drain that excessive liquidity from the system to pre-pandemic levels of 4 trillion. Yeah. And this is the classic example of too much money chasing too few goods, which causes inflation. And the deeper question is, what would happen to global financial markets and to the wider economy if they rapidly drain liquidity from the system and there's a liquidity crunch? Most likely, Matt, we will go into a very, very deep and prolonged recession, which is why they keep too much money in the system and you keep inflation going. What does really surprise me is that you have, you know, some of the top economists and market participants going, on air, surprised that inflation remains sticky and persistent, when the answer is so clear and obvious. One thing is increasing rates. Yes, that is restrictive and slows down the economy, but you've got too much liquidity. You've got $4 trillion more than we had, and that is in the US alone. Can you imagine at a global level, all that quantitative easing, printing of money that has been created? It would have been interesting, and my apologies to the listeners, but it would have been interesting to have a graph showing on at the global level how much money has been created in such a short space of time. So yeah, despite all the noise from the Federal Reserve, from politicians, the reality is that keeping inflation high relative to interest rates, as I've said before, devalues the debt in real terms, in monetary terms, and it's something that Powell will not admit to, but it's something that governments are keen to do because they devalue the debt. But of course, the byproduct of that policy is a cost of living crisis, which I call it a tax on the consumer, because effectively your money has less purchasing power. And yeah, the policies that have been pursued in the past, the price of policy errors is being paid by ordinary consumers. And if you're looking at those in lower income brackets, those are the ones that are really suffering the pain of incompetence at central bank level and governments who've been too wasteful with their financial resources. So this is what I call taxation through the back door. And the other thing, Matt, and I'm sure our listeners will agree, the rate of inflation which is currently being reported is this, by politicians, is disingenuous to even think or believe that that we can rely on that data. As we all know, that data is completely manipulated. It's untrue. And if you go to a food store, to a supermarket, and you buy food, you know that inflation is running at a much higher. You go to buy petrol, whatever it is, the cost of electricity, there's been a real squeeze. The current level of inflation is probably double digits, and it is decimating living standards again, and it's not sustainable. And you have, for example, in the UK, to give one example, you had junior doctors last week demanding a pay increase of 35%. You've got workers working in London undergrounds demanding double-digit wage increases. I mean, the one thing to remember is that asking for ridiculous pay increases, and whilst we can understand why anyone would want that, just feeds into the inflation narrative. So what you do is you ask for a ridiculous pay increase, you get it. This creates a domino effect because it sets a precedent and everyone demands double-digit wage increases, which then increases, you get wage inflation. So increases inflation more, reduces again your disposable income, and the net impact is basically you're paying the same. And of course, higher wages, higher tax. So the net effect is you're exactly in the same position, but you have feeded the inflation narrative. So what is the answer to that, Matt? I don't know. It's a tricky one, yeah?
It's a vicious circle of sorts, really, isn't it? In the sense that the prices, the wages go with that, and I know it's a really good point you made, and I'm glad you did, Paul, about the kind of real level of inflation. We showed the graphs earlier, and that's your official data. But anyone who's been in a supermarket the last 6 to 9 months would have seen the real impact, and I mean, I only know it from my own, but it's quite shocking that the rise in these prices, and that's really the real impact on people's spending power. So perfect. So we'll move on to, and I'll bring up another slide if you don't mind here, Paul, which takes us on to the next section. So so the US dollar, and we can see on that graph, which is should be from 1960, a bit afterwards, and we can see that the US dollar moving higher and with a few fluctuations. So what is driving the US dollar to move higher, and what are the implications of this?
Well, I think I answered that question in the last webinar 6 months ago. I think I said at the time, I stand to be corrected, that higher US interest rates relative to European interest rates and UK interest rates, because they moved much more slower in terms of their tightening, resulted in a flight to safety. The dollar is for now at least the reserve currency, and with higher interest rates and higher returns, and that flight to safety in periods of uncertainty drove the dollar to significantly higher. The US dollar index, which is what the graph is showing, measures the value of the dollar relative to a basket of major currencies. I think the euro is a major component of that basket. Whether it's a 50 or 60% weighting, I cannot tell you, but it's a key indicator of movements in the euro dollar. But there's other currencies in that basket. And I think I said at the time that it had reached, which is to the right, it almost the highest level. In the last 60 years, there's only been 3 times when the US dollar index has been as high as this. One was in during the Iraqi war. Another one was during 1980, where it went really, really high. And another one was during the in the 1970s, with the oil crisis and US high interest rates, Volcker increased rates, and the dollar went through the roof. Yeah, only to fall and then pick up again. So that there's only been in the last 60 years, certainly since 1960, there's only been 3 times when the US dollar index has been as high as it was some months ago. And I warned at the time that this was completely unsustainable for emerging markets, and that if unaddressed would trigger a financial crisis and a global recession. I mean, I was in Africa last week, as you know, Matt, and inflation in Ghana is running at about 40%. 40. And yeah, completely unsustainable. Thankfully, if you look at the graph, it has pulled back, but not, as much as I was expecting. But I do, however, think that once the US rates peak and pause and maybe fall, and with UK and EU interest rates likely to continue rising for a bit more, these the interest rate differentials and other developments in the marketplace will further weaken the US dollar. And by other events, Matt, I'm referring to specifically to the US losing its status as the reserve currency of the world. The BRIC economy is trying to de-dollarize, and parts of the Middle East supporting that movement. And even though we've spoken about it for years, I think there's a real push now to end that dependency on the dollar. I think my best guess at the time, I said it was the elephant in the China shop. I think I said that this would would surprise the market if left unattended. If the dollar continued to increase, then we would see a financial crisis in emerging markets, in the bond market more generally, countries increasing rates very aggressively to stem capital flows from emerging markets, and it would be catastrophic for the global economy. Thankfully, there's been a kind of a pullback, because clearly we would have been heading to a deep recession otherwise. But I think there's still more to come. I think we're looking at the dollar index falling below 100, probably reverting back to about 90, which is just 2021 we were at an index level 90, so the dollar might lose 15% of its value. Remember, all fiat currencies are losing value in real terms relative to gold, but the US dollar in particular is the one which has which would probably suffer the most from the inflationary environment we're in. But look, that was the problem then. And I had prepared my presentation a week before before this, or 2 weeks before. But since we have a new elephant in the room, Matt, if I may allow myself to use that expression, we've had 2 US bank failures, Signature Bank and Silicon Valley Bank. And let me go back in time. The global financial crisis in 2008 was fueled by excessive risk-taking by the US financial sector, from mortgage originators, and I'm talking about Fannie Mae and Freddie Mac, to Wall Street banks. So let's go back in history. Fannie Mae and Freddie Mac were extending credit to anyone looking to buy a US home. They had very little concern about the ability of the borrower to service the debt. We know that some of them didn't have enough income to service the debt. So what they were doing is they were extending loans without following good credit policy practice of banks. They were then lending indiscriminately. Subsequently, they were selling their debt in their balance sheet as a discount to Wall Street banks, which then repackaged the debt as mortgage-backed securities, which everyone, if you leave that graph, which everyone refers to as MBS. So I'll explain again. Giving loans to people who couldn't repay back the debt, selling them that debt from the balance sheet because they knew they would have a high delinquency rate. Bad debts, the bad debt ratio would be very high. So they wanted to take that risk off their book. They sold it at discounts to Wall Street banks. The Wall Street banks then repackaged the debt as mortgage-backed securities and sold it on to unsuspecting investors as AAA rated bonds based on the Wall Street banks' own credit rating. But then, of course, we had the US housing market crash, with prices starting to fall very rapidly. Mortgage repossession soared, and this exposed what everyone now calls the subprime scam, which led to a global financial crisis, meaning the repackaging of debt as AAA rated when it was really junk bonds. The situation we have today, Matt, is slightly different. There's been actually a run on the bank's money due to a lack of confidence in the US financial system. Why? Well, it's very simple. There's high levels of debt and rapidly rising interest rates. Banks have capital requirements, all of them. So on that graph, Matt, they are the blue dots. You got it there. I think the top 20 US banks, they're the blue dots.
Yeah.
So they have by law, they have to have a minimum capital ratio. Now, what they do is that capital that they hold, which is profits accumulated over time and their own capital when they set up the bank, they invest their own capital in low risk, short-term instruments like US Treasuries and other such short-term securities, mortgage-backed securities, etc. Under normal market conditions, that's a perfectly reasonable and sensible thing to do. You've got capital, you want to get a return on your own capital. If we go back to the slides.
Yep, we're back.
Yeah. It's a normal and reasonable thing to do. You use your capital, you invest in short-term securities, you want a return. In a manipulated market where interest rates have been artificially anchored at zero through the use of quantitative easing, right? Then the situation becomes dangerous. Why? Because the Federal Reserve has had to reverse the policy very abruptly and very rapidly to take interest rates to the level they should have been, because having zero interest rates is not normal in any market, right? So they've increased the rates very rapidly. Bonds, so those US Treasuries, which these banks are now holding, and these short-term instruments, whether they're mortgage-backed securities, bonds are always inverse related to interest rates. So when interest rates rise, these investments, these US Treasuries and other short-term instruments suffer huge capital losses. So when there's a run on the bank, like we had with this, I think the banks were what I can't remember the names now.
Silicon Valley, you mean?
Silicon Valley and Signature Bank.
Yeah.
When there's a run on the banks, on the bank, because there's a loss of confidence in the system, the banks are obliged to sell these securities to realize to sell some of the securities to provide liquidity. And when they sell them, because they have suffered losses, capital losses. Why have they suffered losses? I repeat, because interest rates and bond prices move inversely. When interest rates move rapidly higher, bond prices fall in value. So when they have sold those securities to provide themselves with liquidity, to meet the demands of depositors who are taking the money out, they have suffered huge losses and they have gone quickly into a lot of trouble. And so some of them, and they are the red dots, you see that process of realizing losses on their short-term instruments have resulted in their capital ratios dropping from the blue line to the red line. In banks which are not, which are smaller, and where a lot of money there's been a huge run on money, then they've become completely illiquid and insolvent, and they've had to file for bankruptcy. So this is what's happened with the two US banks in question. I suspect that something similar was happening with Credit Suisse. And that's why you probably will have seen that UBS acquired its rival Credit Suisse over the weekend, I guess for similar reasons. Lack of liquidity, and the concern is always, Matt, systemic risk. What do I mean by systemic risk? Like in the global financial crisis. By systemic risk, what I mean is that the problem can spread very quickly throughout the banking system because there's interconnectedness between banks. So banks give each other lines of credit. And when one bank gives another line of credit, if one goes under, potentially drags the other. And if you have two that go under, there's another one with lines of credit who could be also become insolvent. And it has this domino effect. And this has, whilst the origin of the problem is different, it has similarities with the global financial crisis in that, there was a loss of confidence in the banks. Balance sheets became very strained, and most banks during the global financial crisis required capital injections to maintain their capital ratios at levels which were acceptable to regulators. So, yeah, I think, now the Federal Reserve has a huge problem in their hands. Do they keep rising rates, or do they pause to try and avoid a banking crisis? And that is the $1 million question. What are they going to be today? If they keep increasing rates, then it puts more strain on the US banking system, and in fact on the banking system globally. There's no doubt about that. It puts more strain. And whilst Biden has come out and a lot of central banks have come out saying that they will shore up the balance sheet of banks to avoid systemic risk within the banking system. Listen, in 2008, they decided to let Lehman Brothers, for Lehman's to be wiped out completely, right? They didn't save Lehman. And if we're talking about, these are two relatively small US banks. If we're talking about a larger bank, they can't step in and save all of them. There's just not enough money in the environment we're in. So, yeah, it's a dangerous game. And then one other thing, Matt, that people forget, that we've talked about capital losses on US Treasuries being due to higher US interest rates, having caused these capital losses with the US banks. The other thing we often forget is that US banks often compete with US Treasuries for depositors' money. So when interest rates start going up and US Treasuries start paying a better yield, banks have to raise their own interest rates on deposits to attract depositors, which puts further strain on the balance sheet. So I repeat that. US Treasury yields going up, banks are competing with US Treasuries for depositors' money. If US Treasuries are paying 5% and the banks are paying 2% on a deposit, where will the money flow, Matt? I can't hear you.
So the mute's probably no. I mean, it's common sense. You offer the man down the street 2% or 5%. The money will flow in that direction.
So what do banks have to do now? They have to raise their rates to try and stem capital outflows of money from the banks. And in doing so, it puts more strain on the balance sheet because it reduces their profitability. So there's a real problem. There's a big squeeze on the banking system. And again, that could be, Matt, I always say this, unfortunately, it's all coming to roost. Ridiculously high levels of debt, coupled with very aggressive rate increases, is an explosive combination, and which arguably advanced economies cannot sustain. I say that they cannot sustain it. I've said it for the last 3 years, and I repeat it. Unless, of course, we print more money, we kick the can down the road, and we continue doing what has taken us to the situation we're in now. So because no one wants to take the pain, politicians have a short life cycle. They want to be reelected. What do? Do they accept that the system is broken and do something about it? Or do they try and engineer a soft landing? And if something breaks, they quickly reverse policy to try and save us, right? So if anything can break the system, it'll be a deep recession and financial markets crashing. And that is the elephant in the room now, is no longer the US dollar, but there's a new kid in the block, which is, systemic risk in the banking system. So today is a key day, and it's interesting that the webinar is timed for today. It's a pure coincidence, but the Federal Reserve now needs to tread very carefully, because if a policy error at today's Fed Open Market Committee can negate the opportunity to engineer a soft landing and take us into a deep recession. So what will they do? Will they err on the side of caution and do a 25 basis point and be obstinate to show that they're still determined to fight inflation, knowing full well that the rate increases are not enough to bring down inflation? Do they go for the full 0.5%, which could be catastrophic? Or do they pause and then send the wrong signal to the markets? Financial stock markets will rally, and that will cause inflation because of the feel-good factor. So they're on a hiding to nothing. Not an easy decision.
Of course not. I mean, these meetings are always highly anticipated, but I think this one, given what's happened and the build up to this, is probably the key one that we've seen for some time. So I think we've had a lot of great content today, Paul. Thank you. And one of the key questions that I think people want us to ask, the $1 million question, if you will, or the $9 trillion question, is where are stock markets heading from here?
Oh, what a great question. And you're asking me for an answer.
Yes.
I think that people are better prepared to answer that question. Look, I think financial markets, looking at a lot of the financial metrics, have held up really well. And at best, they're trading sideways, right? If you look at the pricing of financial markets, particularly the US, it's already expensively priced relative to the history. I always go back to the history books because patterns repeat themselves over time. And there's different ways of measuring markets, but they are expensively priced. But yeah, the US economy has proven to be resilient so far because of that excess liquidity. Job markets remain strong. Durable goods and housing markets are showing signs of disinflation and weakening jobs and consumer spending. The economy has ticked along, and so long as the economy ticks along, the stock markets will hold. But the question is, for how long can they do so? And the answer to that question depends to a large extent on how restrictive monetary policy becomes and for how long they keep rates high, and whether they're going to pivot in 2023 or not. I think that is the crux of the matter. As things stand now, with the caveat, I repeat, that things can deteriorate quickly, as we've seen with the collapse of 2 US banks. The economic data, while softening, there's no signs of a deep recession. At best, we will have a short V-shaped downturn, maybe lasting 6 months. But again, that all hinges on interest rates pausing or not, job markets and wage growth holding, being robust to engineer that soft landing. The other thing I would say, and something to remember, is that historically, the average duration of a US recession is 10 months. But if they make mistakes in a market with so much debt, then we should expect for a deeper recession, and it's not going to be such a short one. So, yeah, no hard evidence right now that we're heading towards a very deep recession. So no economic evidence to date, but we've got the US banking crisis, which is an evolving problem, and that could be determining where we go from there.
Perfect. And so with that in mind, Paul, what are the investment implications? How does one go about protecting their wealth in this sort of market or environment?
Extremely difficult and challenging. I mean, we see some of the bigger UK investment houses doing discretionary model portfolios, and if you look at their returns for 2022, they've been pretty poor. And the problem is that bonds have become positively correlated with equities. Normally, in a normal market, they are inversely correlated, but they no longer are. So they are, in the past, you would buy bonds to provide diversification and reduce portfolio volatility. So most investment houses, large investment houses, follow the 60-40 model. 60% in equities, 40% in bonds. You know, when the equities go up, bonds go down and vice versa. And that brings stability and allows you to drive alpha, which is excess return, and having that wide diversification. Because they manipulated interest rates and anchored them at zero, actually bonds are now higher risk than equities. And certainly with interest rates going up, you can see that equities have outperformed bonds. Just to give you an example, last year alone, the 10-year gilt, the 10-year UK gilt, a so-called safe haven, I think they lost like 20% in value because of higher UK interest rates. And there's further increases in 2023, no doubt, resulting in further losses in the order of 10% for every 1% rise in interest rates. So we are hoping that this traditional inverse relationship between bonds and equities can be restored when interest rates peak, right? And when interest rates peak, then that might be a good time to buy bonds. But if a recession looms, but certainly if a recession looms and central banks start cutting rates, then yeah, that's a good opportunity to buy government bonds with a longer date to maturity, because bonds will do well in an environment where central banks are cutting rates. But for now, we're in a bit of a predicament because we can't buy the bonds, which traditionally is the safest element of any portfolio, because they're underperforming equities in a rising interest rate environment. And the equities are already excessively priced relative to history. So it's very tricky at the moment. You know, when you buy bonds, there's duration risk, which measures the sensitivity of the inverse relationship between bond values and interest rates. So the longer the bonds, the higher the risk. Extremely challenging environment to drive returns until interest rates pause and we see some kind of pivot by central banks, but very, very challenging indeed. And you know, if you go for the traditional models and go for, you know, the old way of diversifying risk in markets and then potentially you're exposing yourself to an event that leads to a sudden recession and a stock market crash and not being protected from losses.
Okay, perfect. And yeah, I mean, is there assets available that more suitable in this sort of environment?
Well, we like inflation sensitive assets generally because they provide a hedge against inflation. We have a very positive outlook on food security, energy, and defense. The reason being that there's a supply-demand imbalance. So that means that those sectors, energy, agricultural, commodities, and defense, because of the raging war in Ukraine, those supply imbalances will support prices in those three sectors. So they are inflation hedged. We like infrastructure because they are less vulnerable to economic shocks. So, if you look at motorways and utility companies, they can increase their pricing in line with inflation. So it's a kind of an inflation hedge. Also, countries will start doing infrastructure spending during periods of crisis to generate economic activity. So these are sectors that will traditionally have done well. And of course, we remain really positive about industrial metals, but more so about precious metals, particularly gold and silver, which is also a monetary metal besides being an industrial metal. Of course, gold will perform well even if we will go rapidly into a recession, an economic crisis of some sort, and the stock markets crash. Gold will hold its value and probably rally. What you find historically is that silver, being more aligned to the general economy, will initially fall in value, but then follow gold and is more explosive than gold. So even though it lags behind gold, the upside potential is significantly more. So we keep saying, Matt, that investors need to be extremely patient due to the high level of debt that countries have, which is not sustainable. We know that. And throughout history, high levels of debt have led to highly inflationary periods, and periods of economic uncertainty have always been hugely positive for gold. And we are seeing gold just below its all-time highs of 2070. But all we need to see is a Federal Reserve pause or a pivot to see gold rally. I really think that 2023 could be the year where gold breaks all-time highs. I'd be surprised if it doesn't break through 27 all-time high of $2,070 an ounce. That would be a huge surprise, because I think it's definitely heading in that direction. Now, don't ask me when it will happen, because it's impossible to predict. Once the rally in precious metals takes hold, it can be very quick and explosive. As I keep saying, history tells us that precious metals perform very well under these economic conditions, but it just needs a lot of patience to capitalize on the opportunities. We are in a commodities super cycle. We just need to keep our nerve. And besides, precious metals and industrial metals matter, we continue to recommend thematic investments with long-term growth opportunities, and the ones, the ones I'm referring to are battery storage. How do you store clean energy? Because right now there's no technology to store it in sufficient quantities to move away from dirty fuels. Any investments in clean energy, which has fantastic long-term opportunities. Electrical vehicles, which also feed into that shift to the green economy. Yes, and then we need to buy that time and to buy lower risk assets like longer dated bonds when interest rates peak and we can secure a very high yield. And then that would be a time to invest in bonds. But for now, whilst interest rates are going up and there's no clarity in terms of when the Federal Reserve is going to pause interest rates or maybe even pivot and start reducing rates, then there's no point in taking duration risk or interest rate risk on bonds. It makes no sense. So yes, a lot of things we can do, but if there's no magic wand and nothing that will happen quickly, you just need to be very patient, stick to these less traditional assets, alternative assets, which perform well in environments like the one like the one we're currently in, and just hold your nerve. Keep calm, because the winter doesn't last forever. After the winter comes the spring, and you can be well positioned to take advantage of a declining stock market, and where alternative assets perform well, and then rotating back into traditional markets at lower levels from now.
Okay, wonderful. So I guess the final message there, very British, keep calm and carry on, is it, Paul? But don't panic. A longer term view, have to remain patient. I think we say this all the time, but the worst thing somebody can do is panic in a situation like this, because the chances are that you're gonna make things worse and regret that in the long term. So
well, Matt, you're right. I think two drivers of market sentiment, investor sentiment: greed and fear. When the market is very expensive and frothy, and we go out and say, get out, people will slap us in the hand and say, why are you getting out? The market might go up another 5-10%, because it's expensive. We know it's expensive. The market is frothy, right? But the fear of missing out, FOMO, and greed takes hold. I want to be in the market even though it's expensive. And then when markets are cheap, and it's a good time to buy, fear takes hold because the market has come down, and no one dares to get into the market at really knockdown prices where it makes absolute sense that you re-enter the market. So in investing, you have to try and avoid emotion running. You have to have a cold head. You can't make irrational decisions based on emotion. It has to be based on logic. And there's ways of pricing markets and assets. But people expect you give an advice and then in a nanosecond the market rallies. Well, it doesn't happen like that, because there's a lot of variables at play, a lot of factors. Things can change very quickly, as I've explained, with the US banks failing and Credit Suisse almost going into bankruptcy. Things change very quickly, so you just have to keep your nerve. The patient investor will do extremely well in this market. When it will happen, I can't give you a date, but they will.
Perfect. Thank you, Paul. Thank you. And so we've reached the webinar. I mentioned this at the start, and hopefully you can see the details on there. Something that we've introduced is our post-webinar Q&A. So we host a weekly podcast, a Money and Finance for Expats podcast, which can be live streamed on our YouTube or Facebook channels, or you can catch up on our YouTube channel. So I would encourage everyone to visit our YouTube channel, Fiduciary Wealth, and like and subscribe to our channel for much more free content. We're going to be delivering more webinars in the next few weeks. Starting tomorrow, we have our podcast, which is weekly, and we're going to switch to there in 5 minutes, I think, Paul. So please come and join us. You can ask any question you want, apart from asking Paul when something's going to happen. I think you've taken that one off the table. Yeah. But other than that, we're open for that. So I think it just leaves us to say thank you for everyone for joining us. Paul, thank you for the presentation.
No, as I said, Matt, yeah, happy to give opinions, but yeah, the one thing I'm not is Nostradamus. I can't predict events, but we can certainly price the assets and understand what constitutes fair value and what is expensively priced. And on that basis, and on history and patterns of the past, interest rates, inflation, debt, and so on, we use those predictive models to determine what assets we buy. But yeah, but with no ability to provide timings.
Yeah, if it was that easy, we would be, in the Caribbean on a beach, multi-millionaires, predicting these things. But it's not, and that's why we kind of stress we've got to stick to the facts, remain patient, and take a long-term view. So great. Thank you so much, Paul. Thank you, everyone, for joining us. If you're watching this live or on our YouTube channel, we will be hosting the podcast in 5 minutes. We'll see you there with your questions. Thank you, everybody.